10,526 contracts. That's the number that quietly showed up in the CME Group's official delivery report on February 27, 2026. And if you understand what that number means, it should stop you cold. Because on that single day, the first notice day for the March silver contract, buyers on the COMEX stood up and said, "Give me my silver." Not paper, not a rolled over contract, the actual metal. 10,526 contracts demanding physical delivery. That's 52.63 million ounces of silver demanded in a single day against a registered inventory of just 86.13 million ounces. That means in one morning, buyers laid claim to 61% of every single ounce that COMEX had designated as deliverable. And today, silver is sitting at approximately $84 an ounce, down from $94 just 6 days ago. Down from an all-time high of $121.62 just weeks before that. The price is falling, and the delivery notices are spiking. Those two things shouldn't be happening at the same time, and I need to walk you through exactly why, because by the end of this video, you will understand something that most people watching silver prices on their phone have no idea is happening underneath the surface. This isn't noise. This is the structure of the silver market being stress tested in real time. Let's get into it. Let me give you a little context first, because the numbers only make sense if you understand the architecture of what COMEX actually is. The COMEX, the commodity exchange in New York, run by CME Group, is where silver futures are traded. When you buy a silver futures contract, you're buying a promise that at a designated future date, someone will deliver you 5,000 ounces of 0.999 fine silver. Most of the time, nobody collects on that promise. Historically, fewer than 5% of silver futures contracts result in actual physical delivery. Traders roll their positions, take cash, move on. The whole system works because most participants aren't actually trying to get metal, they're speculating on price. But the COMEX does maintain actual physical silver in approved warehouses. That inventory is split into two categories. Eligible silver meets COMEX specs but isn't available for delivery. The owners haven't consented to let it be used. Registered silver is the stuff that's actually on the hook. It can be drawn upon to settle delivery obligations. And as of February 27, 2026, that registered pile sat at 86.13 million ounces. That sounds like a lot, until you realize that 6 years ago, in April 2020, registered silver at COMEX was 240 million ounces. That's a 64.1% decline. Nearly 2/3 of the deliverable silver has left the building over 6 years, and the pace of that drawdown has been accelerating. According to CME warehouse data, registered inventories fell 31% just since October 2025. Not over years, but in 4 months. Something changed. Now here's where I need to pause and talk to those of you who are watching this channel for the first time. About 3 out of every 4 people watching this aren't subscribed. If the kind of data-driven, no-hype analysis you're hearing right now is useful to you, hit subscribe. It costs you nothing. It helps me keep making this content, and it signals to YouTube's algorithm that more people need to see this. I am not here to sell you silver. I am here to show you what the numbers say. Now let's keep going, because this next part is critical. I want to show you that this exact pattern, falling inventory, spiking delivery notices, and a price that's moving in the wrong direction, has happened before. And every single time it did, the aftermath was historic. Go back to 1979 and 1980. 2 brothers named Nelson and William Hunt, along with Saudi partners, spent years quietly accumulating physical silver. They didn't just buy futures and roll them. They took delivery, actual metal, pulled out of the COMEX vaults and shipped to Switzerland. By January 1980, they had accumulated an estimated 100 million ounces of physical silver. COMEX registered inventory was draining, and silver went from about $6 an ounce in 1979 to $49.45 on January 18, 1980. That's an 824% move in roughly 14 months. Now, I'm not saying that's what happens this time. I'm saying that the mechanism was the same. Physical removal from vaults, delivery pressure on the exchange, a price that had to reconcile with physical reality. Then fast forward to January 2021. Reddit users on the Wall Street Bets forum organized a retail, quote, silver squeeze, trying to force COMEX delivery. It was unsophisticated, it lasted about a week, but in that brief window, silver shot from about $25 to $29 an ounce in a matter of days, and coin dealers across the country sold out of physical inventory almost instantly. The mechanism was still the same, real demand for real metal versus paper promises. Now look at what's happening in early 2026. This is neither Hunt Brothers style accumulation nor a Reddit meme. This is something more systematic. And it's coming from multiple directions simultaneously, which is what makes it structurally different from anything that's come before. Let me walk you through the layers of pressure that have been building on the COMEX silver market, one by one. The first layer is China. On January 1st, 2026, the People's Republic of China implemented new export controls on refined silver. China's Ministry of Commerce, MOFCOM, now requires any company wishing to export silver to obtain a special government license. And the eligibility criteria are designed to exclude the vast majority of exporters. To qualify, a firm needs at least 80 tons of annual production capacity. That requirement alone effectively eliminates hundreds of small and mid-sized refiners who have historically supplied Western markets. According to analysts cited by FX Street and A Invest, China controls between 60 and 70% of the world's refined silver production. This isn't a minor supplier adjusting a quota. This is the dominant processor of newly mined silver on the planet, pulling the drawbridge up behind them. And the effects are already visible in real-time data. Physical silver, trading on the Shanghai Gold Exchange, has been running at a premium of $8 to $13 per ounce above New York prices, according to market data from Spar Gold and SD Bullion Analysis. That means buyers in China were willing to pay $8 to $13 more per ounce than the COMEX spot price just to get their hands on actual metal. In markets, when you see a persistent premium like that, it's the market screaming that supply is genuinely constrained. It's not a paperwork issue. It's not a logistics delay. It's a structural shortage. And here's what that means for the rest of the world. Traditionally, when the COMEX or the London Bullion Market Association experienced delivery pressure, traders could arbitrage silver from Shanghai, buy cheap in the east, ship to the west, deliver to COMEX, collect the premium. That pressure valve is now closed. As of January 1st, 2026, the arbitrage route from China to New York is functionally gone. Both markets are now drawing from separate, non-fungible pools of physical silver. A Jinlo Capital analysis published March 2026 noted that on February 9th, Shanghai Gold Exchange inventory hit 10.24 million ounces, its lowest level since 2015, on the same day that COMEX delivery notices spiked mid-month, both vaults bleeding simultaneously. The second layer of pressure is industrial demand, and this is where the story goes from interesting to genuinely alarming. Silver has always had industrial uses: photography, electronics, medical applications. But in 2026, the industrial demand picture has transformed. Solar panels require silver paste in their photovoltaic cells, and there's no commercially viable substitute at scale right now. Electric vehicles use silver in contacts, switches, and power management systems. Some estimates suggest each EV uses roughly 2 to 3 times the silver of a conventional vehicle. And AI data centers require silver in their printed circuit boards, connectors, and cooling systems. Every GPU server farm being built to run large language models is consuming silver. The result? The Silver Institute's data has tracked cumulative global silver deficits for 5 consecutive years. Their 2025 data showed a deficit of approximately 200 to 250 million ounces in that single year alone. To put that in perspective, that's more than the entire registered COMEX inventory today, consumed as a gap between supply and demand in 1 year. And then late in 2025, the United States government officially added silver to the U.S. Critical Minerals List, formally recognizing its strategic importance. That designation changed the calculus for industrial buyers. Suddenly, the companies that depend on silver for their production lines aren't just looking at price, they're looking at availability. And when industrial users shift from just-in-time purchasing to strategic stockpiling, the dynamics of a commodity market change completely. Samsung C&T signed a direct offtake agreement with Canada's Silver Storm Mining in late 2025, locking up 100% of that mine's silver output for 2 years, bypassing the COMEX entirely. Tesla has reportedly been negotiating similar arrangements. When the largest industrial consumers decide they can't trust the exchange to deliver and start making direct deals with miners, the exchange's role in price discovery begins to erode. Now stick with me, because this next part is where the smoking gun appears. Between January 1st and mid-January 2026, in just 7 days, 33.45 million ounces of silver were physically withdrawn from COMEX vaults for delivery. That represented roughly 26% of the registered inventory at the time, gone in a week. A Jinlo Capital research note described that drawdown as occurring while speculative positioning had actually collapsed 77.72% year over year. Managed money contracts, the hedge funds and speculators, went from 54,415 contracts in February 2025 down to just 12,121 contracts in February 2026. So here's what that tells you. The speculators left. The people taking delivery stayed and actually increased their activity. In normal markets, when speculative longs exit, prices fall and delivery pressure eases. What we're seeing in the COMEX silver market right now is the opposite. Speculative positioning is down dramatically. Delivery is at all-time records. That means the people taking physical delivery aren't speculators betting on a short-term price move. They are end users and institutions who need the metal. They have no choice. They have to take delivery. That's a completely different category of buyer, and it's the most dangerous kind for any paper market to face. February 2026, traditionally one of the quietest delivery months of the year, delivered 5,036 contracts totaling 25.18 million ounces. According to Jinlo Capital's analysis, that was the highest February delivery volume in modern COMEX history. And on the very first day of that February delivery period, January 29th, 1,881 contracts were delivered in a single day, 37.3% of the entire month's total, right on opening day. Industrial users didn't wait around. They took their silver immediately. Now here's what makes today's price move so strange. Silver hit $121.62 on January 29, 2026, an all-time high. Then it crashed. It fell below $64 by February 6th, a 47% decline in 8 days. Then it recovered. On first notice day for the March contract, February 27th, it closed at $90.10, and as of this week, it's trading around $82 to $84 an ounce, with a low of $82.46 reported on March 3rd. Here's the question you should be asking. If 10,526 contracts just demanded physical delivery, 52.63 million ounces of real silver, why is the price going down? This is the disconnect. The paper market, driven by future selling, leveraged liquidations, and algorithmic trading, is saying one thing. The physical market, the vaults that are draining, the industrial buyers locking in offtake deals, the Shanghai premium that refuses to close, is saying another. One of them is lying about the true price of silver. And historically, in every commodity market that has faced this kind of structural tension, the physical market wins. The paper price catches up to physical reality. It always has. The Seeking Alpha analysis, published February 26th, noted something critical. After the January crash, COMEX silver inventories did not recover. The metal that left the vaults did not flow into eligible, meaning it didn't just change categories within the warehouse. It left the warehouse entirely. That's metal walking out the door, not shuffling around inside it. Let me tell you about the margin situation, because CME Group's response to this delivery pressure tells you exactly how worried they are. According to analysis published at Work Markets Finance and corroborated by multiple sources, the CME raised silver futures margins by 10% on December 12, 2025, before the March delivery crisis even began. Margin hikes are the exchange's primary tool for managing delivery stress. When the CME raises margins, it forces leveraged traders to post more collateral or close positions. That's how you reduce open interest. You make it expensive to hold contracts, and weaker hands fold. The problem is that the buyers standing for delivery right now are not leveraged speculators. They are industrial users and institutional investors who need the metal. Margin hikes don't deter them. All the margin hike does is push out the paper traders, leaving an even higher concentration of genuine physical demand relative to available supply. This is exactly what happened in 2011, the last time silver went parabolic. The CME raised margins 5 times in 9 days as silver approached $50. That successfully crushed the speculative fervor and caused a 30% correction. But note what happened afterward. Silver maintained historically elevated prices for years because the underlying industrial demand never went away. The physical reality didn't change just because the paper market got repriced. Now I want to put something in front of you that I think is the most important data point in this entire situation. COMEX registered silver inventory, 240 million ounces in April 2020, 86.13 million ounces today. That's a 64.1% decline over 6 years. Shanghai Silver Exchange inventory, 559 tons in November 2025, down to 318.5 tons by February 2026, a 43% decline in 3 months. Jinlo Capital's analysis combined the COMEX and Shanghai drawdowns and calculated a combined 161 million ounce reduction across both exchanges. They noted that this represents about 19.6% of the 820 million ounce cumulative silver supply deficit that has built up over the same period, meaning the exchange inventories are being drawn down to fill a gap between mining supply and industrial consumption that has now persisted for 5 consecutive years. You cannot solve a structural supply deficit with accounting. You cannot solve it with paper contracts. You cannot solve it with margin hikes. At some point, the physics of the situation assert themselves. Either new supply comes online, which takes years to develop in mining, or industrial users bid aggressively for whatever physical metal remains, or the paper pricing mechanism breaks down and a new price equilibrium is established at a higher level. Bill Holter, a senior precious metals analyst, publicly warned in early 2026 that if COMEX failed to fulfill delivery obligations, the credibility of the entire paper pricing mechanism would collapse. That's an extreme outcome that involves a lot of assumptions, and I want to be clear, I'm not predicting that. But the goldsilver.com analysis, which actually pushed back on some of the more extreme default narratives, acknowledged that the raw numbers are real and that the underlying structural tightness is genuine and documented. Even the skeptics aren't disputing the inventory data. So, what does all of this mean for you personally? Let me walk through the practical implications, and I'll be direct. First, understand the difference between what you're buying when you buy, quote, silver. A share of SLV, the iShares Silver ETF, gives you exposure to the price of silver as set by the COMEX paper market. A silver futures contract gives you the same thing. Physical silver in your possession gives you actual metal. In a scenario where the paper price and the physical price diverge significantly, and we are already seeing evidence of that divergence between New York and Shanghai, those are not the same asset. I'm not telling you what to buy. I'm telling you to understand what you actually own. Second, premiums on physical silver are already elevated and likely to remain so. Coin dealers and bullion retailers typically charge a premium above spot price. In tight physical markets, that premium expands. If you're watching the spot price on your phone and thinking that's what it costs to buy a Silver Eagle coin right now, check an actual dealer's current ask price. The spread between paper and physical is your real-world signal about where physical supply actually stands. Third, watch the COMEX registered inventory number weekly. CME Group publishes this data daily. The number to watch is registered, not eligible. If registered silver continues to drain toward 50 million ounces, the math of any major delivery month becomes extremely uncomfortable. If it recovers, if eligible silver gets converted to registered in large volumes, that's a sign of easing pressure. Right now, the trend is down. Fourth, watch the Shanghai premium. If you're seeing SGE prices persistently $8 to $13 above New York prices, that tells you physical metal is genuinely scarce. If that premium collapses to near zero, it signals either that Chinese demand has softened or that new supply has entered the market. That premium is a real-time diagnostic tool. Fifth, watch silver mining stocks. Companies like First Majestic, Pan American Silver, and Wheaton Precious Metals are leveraged to the silver price. Their profits amplify silver's moves. If physical silver demand is as structural as the evidence suggests, primary silver miners become some of the most operationally leveraged positions in the market. I'm not making a specific recommendation. Do your own research, consult a qualified financial advisor, and understand that mining stocks carry operational risks entirely separate from the silver price itself. This is not financial advice. I'm describing relationships, not prescriptions. Sixth, the timeline. Based on historical patterns, the 1979-80 hunt squeeze, the 2011 commodity peak, these structural situations tend to resolve faster than people expect, in one of two ways. Either the market finds new supply, or demand destruction solves the deficit, or prices move sharply enough to force equilibrium. Given that industrial demand for silver is largely inelastic, solar manufacturers, EV producers, and semiconductor fabs don't reduce consumption just because prices double, the demand destruction scenario seems less likely than in other commodity cycles. The path of least resistance is price adjustment. Seventh, and finally, context. Silver hit $84 today. It hit $121.62 on January 29th. It hit $94.26 on March 2nd. It's been extraordinarily volatile. Anyone who tells you they know exactly where silver goes from here is either lying or deluded. What the data tells us is that the structural backdrop, inventory depletion, China export controls, industrial demand growth, delivery notice spikes, has not changed. Volatility is the price you pay for being right early. The people who bought silver before the Hunt Brothers squeeze were briefly underwater before being dramatically right. The people who bought in 2011 were briefly very right before giving much of it back. Know your time horizon, know your position size, and don't invest money you can't afford to have locked up through volatility. Let me bring this full circle, because I want to make sure the core logic is absolutely clear before you close this video. We started with a number, 10,526. The delivery notice count on first notice day for the March 2026 silver contract. 52.63 million ounces demanded in one day, against 86.13 million ounces available. That's 61% of deliverable inventory committed in a single morning. We trace that pressure back to its sources. COMEX registered inventory down 64.1% since 2020. China's Ministry of Commerce implementing export controls effective January 1st, cutting off 60 to 70% of global refined silver exports. Industrial users, Samsung, Tesla, solar manufacturers, bypassing COMEX entirely and locking up mine supply through direct offtake agreements. Shanghai physical silver trading at an $8 to $13 premium to New York. Both major global exchange vaults draining simultaneously, with no arbitrage route available to relieve the pressure. We identified the anomaly. Speculative positioning down 77%, but delivery volume at all-time records. That means the people standing for delivery are real buyers, not paper traders. The CME's margin hike tools are less effective against that kind of demand than they were in 2011, because you can't deter a solar panel manufacturer from buying silver. Their production line requires it. And we watched the price do something strange, fall from $121 to $64 in 8 days, recover to $90, and now sit at $84, while delivery notices spike to historic levels. The paper market and the physical market are telling different stories. They can't both be right forever. In 1979, most people didn't notice the silver vaults draining until prices had already moved 400%. In 2021, most people heard about the Reddit silver squeeze after the move was already over. The signs this time are not hidden. The CME publishes inventory data daily. The delivery reports are public. The Shanghai premium is trackable in real time. The evidence is sitting in plain sight. I want to be completely clear. I am not a financial advisor, I don't know your personal financial situation, and nothing in this video constitutes investment advice. Precious metals carry price risk, liquidity risk, and storage costs if you hold physical. Silver is extraordinarily volatile. You saw a 47% decline in 8 days this January. This content is educational analysis based on publicly available data. What I do know is this. The structural backdrop for silver in 2026 is unlike anything the market has seen since at least 1980. And the people who understand the mechanics, the delivery system, the inventory data, the China export story, are operating with information that most retail investors simply don't have. That's why this channel exists. Drop a comment and tell me this. When you look at silver right now, down to $84 after being at $121 just weeks ago, does the dip feel like an opportunity to you, or does the volatility make you want to step back? I want to hear both sides. I read every single comment, and your perspective genuinely shapes what I dig into next. If you haven't subscribed yet, there's a button somewhere on your screen right now. Hit it. We've got a lot more to cover. Gold's relationship to the silver story, what the Fed's next move means for real asset pricing, and the mine supply pipeline that almost nobody is talking about. You're not going to want to miss it.